If World War II started tomorrow, the first thing most people would do isn't call their mom, it's open their brokerage app. That's what financial anxiety does. It hijacks your instincts and redirects them toward a portfolio that probably doesn't need your help right now. Here's the truth. While you're panic selling your index funds at 6 a.m., someone else is doing something that looks insane to the outside world. They're buying. And if you don't know the history of war and money, the next crisis will cost you a fortune. First, meet Nick. Smart guy, stable job, but he watched Ukraine invade Russia on repeat. He saw the word crisis 47 times. He sold his entire portfolio by 9 a.m. Then there's Lucy. Same portfolio, same news alerts. She read one data point. The S&P 500 recovers from major conflicts within an average of 47 trading days. She turned off the TV. Here is what the financial media won't tell you. Markets don't die in wars. They dip, they panic for a few weeks, and then, almost without exception, they climb. The Dow gained 50% during World War II. The market has survived nuclear standoffs and debt ceiling crises. Wars are economically the most aggressive government stimulus programs in human history. The government becomes the largest customer overnight. Nick sat in cash for 4 months, paid capital gains tax, and re-entered after the best gains were already gone. Lucy didn't win because she picked a magical stock. She followed a counterintuitive order based on history. Here's the framework. Step 1, the floor. 6 to 12 months of expenses and high-yield savings plus physical cash for potential banking blackouts. Stop here. Excess cash evaporates due to wartime inflation. Step 2, gold. 10 to 15%, but don't buy it during the panic. It spiked to ruin in 1980 and 2011. Buy structural demand shifts via ETFs. Keep small physical coins just in case digital infrastructure fails. Step 3, defense. 10 to 15%. When governments fight, they spend billions on logistics and weapons. Lockheed Martin returned over 1,200% since the War on Terror. Defense stocks outperformed the S&P 500 by 28 points in 2022 alone. Step 4, energy. 10 to 15%. Conflict restricts supply and drives premiums. When the S&P 500 was down 18%, energy was up 64%. Step 5, consumer staples. 10 to 15%. People stop buying vacations, not Tide or Tylenol. These are the beige cardigans that keep you warm. Step 6, inflation protection. 5 to 10%. Avoid standard bonds. Wars print money. Use TIPS or Series I savings bonds which adjust for CPI. Now here is the one thing you absolutely do not touch, your broad index funds. Large cap stocks returned 11.4% annually during wartime, higher than peacetime averages. If you have a Roth IRA, a downturn is the best time to convert or contribute. You're buying tax-free growth at a discount. Let's look at the result. Nick ended up with roughly $48,000 4 years later. Lucy, who kept contributing and added those tactical positions, ended with roughly $91,000. Same starting point, same news, a $43,000 gap. The person without a plan opens their app when the missiles fly. The person with a plan made their decision before the headlines hit. Your instinct is to hide, but hiding in cash guarantees losses from inflation. Buying the fear ensures returns. The media profits from your panic. The system is designed to prevent you from building wealth. The time to become the second person is right now, before the first shot is fired. Don't let the panic sell your future for temporary relief. Build the floor, load the position, have the plan.